Most crypto investors aren't ready to file their taxes. Cryptocurrencies or virtual currencies are surging in popularity and beginning to gain more interest from hobbyists, speculators, and investors. However, these investments often come with tax obligations. The Internal Revenue Service (IRS) is wary of the developments in this market, but there's a chance their activities trigger any crypto tax reporting implications. Luckily for you, Crypto Clipper, in this video, we'll be talking about how 3/4 of crypto investors who are not prepared to file taxes, useful tips for cryptocurrency investors like you, and how you can file tax without a problem. Remember that while the first step is completing any of these amazing courses, the second and possibly more important step is taking action even if it's imperfect action. Now, let's get into this video. Lacking tax knowledge, many Bitcoin investors are underprepared for the April 18 deadline to file their taxes. It's not surprising that 96% of US cryptocurrency investors were unaware of any deadline for filing income taxes by the start of March, because there is clearly a lack of general knowledge about how to report cryptocurrency earnings in the United States. Around 84% of crypto investors in a recent poll were not completely confident that they know all of the information required to calculate taxes. With imperfect answers, only 3% of respondents answered correctly on all the possible questions, and 97% got one wrong answer. For example, 58% of users don't realize that you have to pay taxes when trading cryptocurrencies between different types. This is especially important if you trade Bitcoin for Ethereum. And 64% of people didn't understand that cryptocurrency is taxed when used as a form of payment. This sort of misinformation could lead to inaccurate filing of tax returns, which may end up with people paying too much or too little in taxes. In today's world, it's difficult for cryptocurrency users to remain tax compliant. A survey conducted by CoinTracker shows that out of 3 exchanges or wallets, 2.93 of these users experienced a transaction in a different exchange or wallet in the last year. 75% of users added a new exchange or wallet in the last 12 months, meaning that 75% of participants did not know about how to file taxes based on multiple exchanges and wallets. With this information and knowledge gaps in mind, CoinTracker plans to focus on more accurate and efficient filing processes in the future, which will help cryptocurrency users save time and money. Now, let's go on how you can file cryptocurrency on your taxes. If you made a major gain or loss in Bitcoin and other cryptocurrencies, you should report those gains and losses to the IRS using Form 8949. You will have to pay capital gains taxes on your profits if you make any. It may be hard to forget that you are required by law to report your gains with 1099. The process of reporting can be confusing, but don't miss the deadline or else you'll risk financial penalties. Cryptocurrency is an area that the IRS is continuing to focus on for enforcement, says Brian R. Harris, tax attorney at Fogarty Mueller Harris PLLC in Tampa, Florida. He believes even if you don't receive a 1099 or any other kind of statement from your exchange, you still must report this income earnings. The following is what you should know about declaring your gains and losses and how to use Form 8949. Who should use Form 8949? It's important to understand that with cryptocurrency, you don't owe your taxes until you have experienced a gain. In contrast to other investment vehicles, you can generate a gain on cryptocurrencies in 2 ways: buying and then selling crypto for profit in a taxable account and exchanging crypto for goods or services that are worth more than you paid for it. If you have a taxable capital gain or have legal obligations to declare it, please mention it. If not, your only consideration is to not pay taxes on it. However, if you realize a gain in a tax advantage account, such as an IRA, then you need not report any transactions. If you have cryptocurrency, they are not widely available in IRA plans. If your account has taken a loss, you can offset the loss from other income and reduce your tax bill. It may not feel like much, but it will help you and lower your overall tax bill. Now, how to report your gains on cryptocurrency. By filing out Form 8949, you've made the declaration that the crypto transactions in the appropriate tax year have been made. You'll need to fill out Form 1040 if you haven't any other income. To report your cryptocurrency gains and losses for tax purposes, use Form 8949. Then, enter this information on Schedule D of your taxes, which reveals the total capital gains or losses you incurred. The 8949 form is used specifically for a sale of cryptocurrency. It's important to keep track of the date and time you sold it, as this will help determine how much your investments are worth. The purchase and sale dates are important as they help determine how long you've had your asset before selling it. The gain on your cryptocurrency will be taxed at a rate that is usually higher than the one that you earned from the sale of it. If you sold your cryptocurrency for less than 1 year, these rates are between 5 and 37%. If you hold the property for over a year, it becomes a long-term investment. Long-term capital gains tax rates are 0%, 15%, or 20%, depending on your income level. Long-term investments can be purchased on Part 2 of the form, which is nearly identical to Part 1. It's also important to note that if you generate any income from cryptocurrency mining, you'll want to report this elsewhere. To provide the details of your crypto gain loss, you use Form 8949. As you determine whether your gain or loss is a short-term or long-term, you'll need to enter the details of the transaction in the appropriate section of Form 8949. All transactions require the same information entered in either Part 1 or 2 in the correct column. Once you enter all the transactions on Form 8949, subtract your cost basis from the total proceeds to calculate a capital gain or loss. Schedule D then determines how much tax you need to pay or what kind of refund you can receive. Question: what if you don't receive a 1099 from your crypto exchange? Most brokers and some cryptocurrency exchanges provide Form 1099 tax information about your trades. But just because you have this data, it doesn't mean that completing your taxes is easy. One of the most pressing issues related to crypto trading is the lack of regulations in every country for tax reporting. In order to avoid taxes, traders need to figure out their tax liability in each country where they trade. With typical reporting, traders struggle to determine the potential gain or loss on each trade. Harris said that it's going to be up to you to establish your holding period, your cost basis, and your proceeds. This means digging through your records to find the purchase and sale dates and any related information on Form 8949. Since this could be a tedious process, it's a good idea to have this information organized beforehand. Rule-based investment menus manage which tax lots are sold when determining whether a given sale is considered short or long-term. For example, if you invested 100 bitcoins in January, bought 100 more in February, and then sold 250 bitcoins in March of the following year for a profit, you would have both short-term gains for investment held for less than a year and long-term gains for transactions that were invested more than a year. However, how do you determine which portion of your tax will be paid based when you made the investment? Harris says, unless you specify a specific Bitcoin unit, you must use first in, first out accounting. This means that the oldest purchases are made first and will be accounted for up until all of the coins have been accounted for. In the case of this example, you will see long-term gains from the first 100 coins bought in January and a short-term gain from the second 100 coins bought in February. The next 50 coins were only purchased during December to March of the following year. It's important to split these transactions into short-term and long-term. The IRS Form 8949 asks for this information and summarizes for you. How do you report gains on cryptocurrencies you've spent? The reason for this is that, as stipulated by the IRS, you can trade cryptocurrency to have a taxable gain. Trading is complicated, and taking into account everything involved in trading a cryptocurrency, it would be hard to use it as actual money. At this point in the conversation, Harris talks about how if you are exchanging cryptocurrency, it's a type of sale and would be taxable. For example, he mentions that if you would have sold the pizza when you purchase it with crypto, it would result in a gain or loss. You'll need to figure out the value of the transaction you made compared with what you paid for your cryptocurrency. This will help determine how long it has been since you acquired it and if that is during a sale or a gain. Those who are new to trading cryptocurrency should use a form like Form 8949, which is used for calculating capital gains and losses. Using this tool, these traders can enter the gains and losses according to their transactions. The Form 8949 is a commonly used document that can help save you money on taxes and take advantage of any available tax credits. It also provides important details like the amount of realized gains or losses and whether or not you have any unclaimed capital gains. Even though an exchange may not provide you with your true taxable income, you're still responsible for paying your tax liability. Now, let's move on to the next part of this video. Filing your tax will never be a problem with CoinTracker. Crypto exchanges prepare for the upcoming rate hike with the announcement of a partnership that will allow users to use an exclusive tracker for prices and portfolios for free. The partnership between Coinbase, one of the largest crypto exchanges worldwide, and a company called CoinTracker will provide discounted rates on its services. On CoinTracker, a platform created by TechCrunch co-founder and CEO John Lerner, this website tracks about $500 billion worth of the world's cryptocurrencies and is used by 3% of all coin trackers, who have access to aggregated transactions across 100 different exchanges and dozens of blockchains. This allows users to gain insight on their holdings in one place. The CEO of CoinTracker talks about how they were looking to broaden their integrations into cryptocurrencies because back in 2018, there were a few top exchanges. Now, DeFi and NFTs have become really big. He hopes to use the funding to be able to cover more use cases for crypto investing. As a global platform, CoinTracker offers people across the globe portfolio tracking functionality starting at $14. The platform, which also offers tax support services for only customers in the US, UK, Canada, and Australia. For US-based users who have crypto holdings, the annual tax plan from CoinTracker is free. The company's paid plans range from $49 per year to multiple hundreds for advanced users, according to Lerner. Making it easier for individuals to file taxes, the portfolio tracker features auto-run and tax functionality. Its ease of use has driven its traction, according to Lerner. The biggest risk facing the company is that digital assets may not be considered taxable, resulting in penalties and audits. Lack of awareness and education on how to properly report digital asset holdings is an issue for users. Lerner said that their job is to make the decision for you about how to do this and take the friction out. You can connect your apps, everything will be synced up if you're working with a CPA or power user. Now, for your much awaited part, we will give 3 tips for investors like you. Number 1. You need to be well versed on the history of IRS guidance and releases on virtual currencies. IRS guidance on the taxation of virtual currencies dates back to 2014. The IRS released its Notice 2014-21, which proclaimed that virtual currency transactions would be treated as property for federal tax purposes and that it will be classified into 3 categories. 1. A medium of exchange. 2. A unit of account. And 3. A store of value. Number 2. The IRS may instigate criminal proceedings to individuals and investors for failing to report or falsely reporting virtual currency transactions. Recently, the IRS has been increasing their efforts to investigate and refer to criminal prosecution individuals who are engaging in criminal tax fraud concerning cryptocurrencies. A new study finds that the IRS is concerned about a lack of regulation in cryptocurrency markets and how this leads to crime and fraud. A greater portion of resources should be devoted to preventing such problems with increased government regulation. With scams like money laundering, terrorism financing, wire fraud, cyber attacks, and ransoms increasing because of the pseudonymity of crypto transactions and lenient AML KYC laws, the IRS is keen on investigating those who are intentionally failing to report their income from virtual currency transactions. And lastly, tip number 3. Some cryptocurrency transactions affect tax reporting requirements, sometimes both at the time of receipt and the time of sale or disposition. Before you invest large amounts in cryptocurrency, you need to understand that there are legal and tax obligations associated with such action. Depending on the type of cryptocurrency, an individual could be required to file a tax return or a report with the IRS. Some on listing certain virtual currency transactions, including when selling or exchanging cryptocurrencies, when owning or receiving airdrops from ICOs, and when trading for physical coins might create tax obligations. On that note, cryptocurrency mining triggers two taxable events. The first tax event occurs when a computer miner receives the cryptocurrency as the reward for being the first to successfully verify the transaction. This is reported as ordinary income. Second, with the conversion of cryptocurrency to USD value, a capital gains tax event may occur. This is reported as either short-term or long-term, depending on how long the individual held cryptocurrency before being converted. Lastly, by using Section 162 of the Internal Revenue Code of 1986 from 2003, businesses can take deductions for mining activities. That's it for this video, Crypto Clipper. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!